Wild day in the stock market with the PCE coming out better than expected across the board. Bulls going crazy, specifically technology bulls. And you can just see how we held that pre-market high as we started to push higher and higher. For the rest of the day, we saw the breadth increase. We saw more and more participants get into the market. We saw rotation accelerate. We're going to talk about where that rotation is going into. While this is very similar to what happened in 1980, and one fact about technology stocks that has held truth since about 1960. So we have a lot of data to cover, several sectors and stocks that look ready to break out, and one sign that retail is smarter than institutions. Hey everybody, in today's video we're going to be going through what happened today with PCE, why this looks similar, what's the big news we're looking for next week, and how to play the sectors that are starting to break out and the rotation we're seeing. There's a lot of similarities here between now and 1980, and we're going to get into some details here, but let's focus on what happened today. We have this low put in. This is the previous high from that low. You cannot confirm that this low is a confirmed low until you break that high, right? Just very simple technical analysis. So here we are, and we've done that today. So you can say whatever you want about the market. We can call it a bear market and a bull market. We could call it a blueberry for all I care. But the bottom line is this bottom has held. And now it's really hard to say that you don't have some level of confirmation that you're holding. You have flipped over here. You're now flipping these lowers. You're now flipping, if you break this down, you're now flipping this one. So over and over again, you're confirming. Now, that doesn't mean that you're not going to have pullbacks. It doesn't mean that you're in a runaway bull market. Again, stop trying to label things. People do it all the time. Just focus on what is happening. As I like to say, trade what's in front of you. And right now, it is pretty clear that you have a trend line that is pointing up. This trend line is confirmed by this move flipping right here. So we know why. And we know that it was based upon PCE coming out and being much better than expected. We also know that we're starting to see in the banking sector, 12-month snapshot of the banking sector. And you can see how we're holding right in here. Look at this. So we undercut and then held. Let's look at the weekly. So if we look at the weekly, we can see we're sitting right on major support. And if we scroll back all the way, you can see this is from when we had the great financial crisis and then obviously the pandemic. And then you can just see the carnage from there. Now, see this doji? What we needed to do was flip above that doji and close. And that's exactly what we did, closing financials at the high of the week. So it is possible that this is a bottom. The one concern that I've had is we just weren't aware if SIVB, was this a Lehman moment where we're setting up for another great financial crisis? Or is this something like long-term capital? Because if it's something like long-term capital, that's probably going to be the washout that we've had versus the great financial crisis. In other words, what we're really waiting to see, or what I should suggest I'm waiting to see, is how many other issues that we have here. Do we have more issues, or is that it? Candidly, with how long it's been, it's making me think that we're not going to have more issues, but I am a little concerned about why certain bank stocks are not running. But we can see the trend line here, the break. We're all aware of the story at this point. Now, this is exactly what happened during the great financial crisis. We just completely imploded on the way down. You can see your trend lines, how we're sitting right in here. And this is pretty important, but most people know this. But you always want to clone your lines because you want them to have the same exact trajectory. And then just look for the biggest amount of data points, where you're going to find the largest amount of data points. And we never really close below there. 1, 2, 3, 4. When you have these wicks down here, I would use this 5. So you can see your channel, the break of the channel, and the absolute carnage. This is what I mean when I say Lehman moment. Now in 98, what happened was we had a hedge fund that blew up. That was actually, the hedge fund was so big and so levered, they were actually a systemic threat to the entire market. And you can see how we were trading down into it. Nobody really knew why, and we found out later. They also were tied to Russian bonds, and Russia was defaulting on bonds around this time. Now, if you take a look at this, what we did was stay down here for a little bit of time, and then obviously we had the huge run in the market. This is why it's so important to understand with SIVB, and when we saw SBY fall and we saw FRC still having issues, you want to make sure that this is not a systemic threat to the entire banking system. And it's starting to appear that it's not. Now, can things always get worse? Of course they can. But understanding that, we can then look at this and see this with a little bit clearer eyes and just look at the S&P weekly and just kind of look at this box that they have us in here that's almost too perfect, and you're really setting up to flip that box. Now, you can make the argument that there is another DTL right here, and that would be true. You could see that. But I would also use this point, and I think this one is way more predominant because you're hitting more data points. And if you really look into it, you can also see how you've come back and back tested that level and then held in there. So you could make the argument that this held, it got to the kill zone, as I refer to when you have two lines crossing, and pointing up. But I also think that you just want to watch what's going on right here. I don't think you want to pretend that that's not, even though this one would be the more predominantly line to me. So now we know where we're at. We know we're hitting higher lows the whole way up. So it's very difficult to say that this is not the bottom. It's been 6 months, whether or not you want to call the bottom now or you want to wait for it to hit new highs. It's completely irrelevant. It's very clear what's going on out there right now. So here we have our wedge, and we can see the wedge pretty clearly up here. And what I want to just point to so that we can take a look at what exactly is going on is you can see a wedge right down here during 1980, 81 as well. And you can see how we broke out of that. So if we just kind of look right here and say, okay, well, this is where we peaked. You can even say that you peaked down here, but let's use this peak just for a moment and just take a look at that. And you can see that level and how we flipped right there, right? And that could be something similar to what we are possibly setting up here. You can see how we sold down massively in 1980. You can see the huge push, and then we went sideways, very similar to what happened up here before finally cracking and coming back down and then building our way back up. There are similarities technically, but there are more similarities than just the tech. This data we're about to go over is from the Federal Reserve Bank of Minneapolis, or the Minneapolis Fed. And I want to show you what we're going to look at here. We're going to look at CPI, and it goes back 100 years. And what we're going to do is just focus on one key time here and look at what these rates were. And the time that we're going to look at is going to be right around that 1979, 1980, 1981. Now you can see the 11.3%, the 13.5%, and the 10.3. Now you can see 4.7 and 8.6. The first similarity is this is the highest we have been on CPI since 1980, but there's a much larger correlation. In front of us is the 10-year Treasury going back to 1980. Here are the CPI numbers during that period of time. And what I'm going to show is pretty significant because it did not happen for a very long period of time. Think the Depression versus what we're seeing right now. Let's take a look at this and go through it. There was one other time in the 50s, very, very briefly. But if you go and take a look at this level right here, and you say 1979, and we're going to take that peak, and we're going to see an 11% on the 10-year, and we're going to see 11.3%. This means CPI was actually higher than the 10-year. Meaning if you put your money in treasuries and lived off that money, you still were losing money the interest is not keeping up with inflation. Now, if you look at 1980, you look at the peak that you have in here, but then look at the average from 1980 on, you have that peak, comes back down here, and then you can see by the end of 1980 how you collapse and you're at 9%. So if we just put this here, just so we know where we're at, I'm not going to use the exact peak. We can though, and it'd be right in line. Either way, using the peak or the average of the time of that year, you're higher. Okay, CPI is higher. So it is higher than the inflation, or inflation rather, is higher than the 10-year. And 1981, if you go and take a look at 1981 and you look at how that's playing out, you will start to see a change. Do you see that in 1981, how you're at 10%? And then you start looking at 81 and what starts to happen. The change starts, and that change is, we'll just leave it up here. Let's put it right there to start, okay? And the change is that CPI is no longer higher than the 10-year, meaning in 1981, if you went out and bought the 10-year and you were getting 13.7% and inflation was 10.3, well, you were keeping up. All of a sudden, your money was keeping up by buying treasuries. Okay. During this period of time, that was not happening. Now, if we take a look at what's happening here, 2020, we're all aware of the pandemic. And let's even just take a level in here and say, you know what, we're going to take the absolute, that March high where you had the panic, and just say, okay, well, even in buying there, we still were in a position where CPI was higher than the 10-year. So And that's just taking the peak. If you took the average, you'd be around here, around 81 basis points for the year. But let's just leave it there because it still is on the high end, but still kind of highlights what we're trying to show here. Now, if you take a look at 2021, you just drop a line right there at the peak. You'll see 1.75%. At the time, the CPI is 4.7%. Once again, if you're putting your money in the 10-year, you're not even close to keeping up with inflation, but that's okay because the stock market's moving, right? Well, wrong. 2022, 8.6%. So then you come out here and go, well, let's just find that peak. And we can use either peak. We can even use this one, right? And even there, you're not even close. So what is going to happen? Well, when they start cutting rates and CPI starts to drop, the same thing that happened in the early 80s is going to happen to our market. In other words, you're going to see bond prices come down but at the same time, CPI is going to implode. And when CPI implodes, what you're going to get is equity prices rising. Now, there is this massive disconnect where people are saying, well, when you cut rates, that is when you have to watch out and be aware of equity. That is not true if the 10-year is in double digits and CPI is in double digits. In those cases, equity prices actually rally. If we take a look at this and you go from 81 down all the way to 86 before we have the flash crash, if you take a look at that, all we've done is just keep dropping, right? Yield just continues to drop. And if we take a look at what happens to CPI during that period of time, you can see how it's just absolutely plummeting. Now, the 10-year is in blue and the S&P is in orange. If we just watch 1980, 81 play out, you can start to see how they are moving obviously in tandem. But as we start to see the peaks in the 10-year, and you can start seeing how they're peaking right there, you're going to start seeing a disconnect. This is the kind of disconnect that you could continue to see have happen. And this is the kind of disconnect I think we're going to start seeing in our own equity markets, especially after the way we reacted to the PCE today. But you can just want to watch those peaks and then you want to see what happens, right? We peak and then what happens? We fall down and then rates start dropping. At the same time rates start dropping, we're going to start seeing the equity prices are going to start rising. As equity prices start to rise, right, that is where the drivers become. Now, they're buying equities because at this time they're buying yield. We're dealing with levered buyouts, that kind of thing, right? So you can see the plummeting right here, and then we start taking off. And we're going to stop this, and let's clean this off for a moment. This is the exact pattern we were just talking about. We said it looked extremely similar to what we're dealing with right now. Now, we just watch this play out for a second, and you can start to see how even when rates are up or down, it no longer matters. The correlation has changed drastically. Once we plummeted in rates, which is what everybody's saying, oh no, when they cut, we're in trouble. What does it look like they were in trouble here in 1980 when they had the same issue with CPI being higher than the 10-year? And the answer is no. This is the only correlation that we have to work with, and it bodes very well for equity prices. The reason for understanding that is so you understand where we are in the economic cycle. It's not going to affect how you day trade. It's not going to affect anything like that. What it's going to affect is it's going to affect your outlook on the market. So you can understand why we're rallying today, why the bond market's rallying. This is what's important. When you understand the nuances, you get a lot more deadly. I'm going to be clear about my position and where my head is with all of this. A lot has changed in this week, a lot. And we're going to talk about the regional banks. We're going to talk about the news that has come out in regards to the market and how the market's reacted to it and why we're seeing rotation and some other signals here that are just absolutely glaring. But let's jump right into high yield bonds. So we're starting to see this base in high yield bonds. And when bonds move higher and they want to buy high yield, well, that means that they're comfortable with the debt of corporations that are under investment grade, meaning junk bonds. Well, you're not buying junk bonds if they think there's a quote Lehman moment out there. In the past 72 hours, we've seen massive buying in the high yield, so much that we're gapping up. Okay, that's how aggressive they're being buying. And if you really zoom in on this, which yes, I do this, and yes, I see these gaps and these gaps here too, and that's an exhaustion, right? But what I'm pointing at is this. Look at this. There's so much buying in the past 72 hours of high yield that the ETF itself, to reprice itself, is gapping up off the open. Okay. Yep, you've had it a couple times here. You really have not had it like this. To put it in perspective, you can see the difference in volume coming in. You can see how we are back above the 200-day moving average. They are buying high yield bonds. So you would buy high yield bonds if you thought that this was more like long-term capital. If you thought that it was a situation where it's going to be a Lehman moment, then we're going to have an AIG, you would not be out there buying high yield. You would be selling it. You will remember this graph from Sentiment Trader if you've been following us for some time. And you can remember these BBB, AAA. So this is investment grade, which is obviously more risky. But if we just take a look at the 10 years, you can see 2016 was higher. The pandemic, the spread was substantially higher. Let's go out 20 years and you can see the great financial crisis, and the spreads were up to 4% between BBB and AAA. And right now we're under 100 basis points. Now, if you just simply drill into this, you can already see what's happening here. The spreads have been getting tighter. They're already getting tighter. So they are going out there and buying bonds. And as those spreads get tighter, what happens? Equity prices rise because the bond market has confidence that corporations are going to be able to meet their debt obligations. In front of us is the Nasdaq on the monthly scale, and the blue line is going to be rate of change. I want you just to think of rate of change about how one bar is next to the other bar. In other words, the calculation rate of change is the previous value divided by the current value minus 1 times 100. And what you'll do is you'll get a number. Now, what this will tell you is it'll just tell you basic momentum. It'll tell you how fast something is moving in one way or another. In other words, you could say you're just flatlining roughly, and it's really not telling you a lot. And then you have these anomalies where it's telling you certain things, right? For example, if you take a look at November 2000 and December 2020, what happened here and how we peaked, and it really didn't matter at first, but then a year later it started to act up because you have this negative divergence between rate of change and what's happening in the market. So you know you have an issue, you just don't know when that issue is going to come home to roost, right? And it doesn't always work, but it's worth paying attention to for the one signal that it is giving that is glaring. Now, every time that we are crossing the zero line down or up, it is giving us a very clear indication on what's going on. But in order to perform whether or not you're at a bottom and say, oh, are we at a bottom? You need to break that zero line and then find a position where you then get back over it. Now, once you do that, you'll find yourself seeing the bottoms on a lot of these tech markets. So if we take a look at this market in July and realize that, well, we never went any lower than this little area right in here, and you start taking a look at April 2003 and go, well, wait a minute, we never got any lower than that there, right? So I think that's an important distinction. So then we would go and take a look at it and say, okay, well, we have these little anomalies and we can use those, but what we're really looking for are the big moves. So we look down here and we see rate of change, and look what happened in March. So the same exact move that called the bottom in the Nasdaq, Chartlng.com, same move that caused here great financial crisis. Look what happened. We have it again. So now you have a data point that you could utilize. Would we want more data points? Sure, but this is all we have, and all I can give you is all that we have. So if I look at that and say, well, this called the bottom of the dot-com bust when nobody believed it. This called the bottom of the great financial crisis when no one believed it, and times were still tough in 09, and we all know how tough it was 09, 2010, 2011, right? The economy wasn't great, but the market was going up. Same exact thing can happen here. And I just want to point something out that I think is very important about this. Whenever this line has gotten to this level, which is roughly a 16 on the monthly, whenever you've gotten up to this level off a zero line, you really have not rolled back down unless it was like 6 or 7 months later. So you're welcome to wait for that, but I would not rule out what I'm showing right here. So besides looking at this chart, besides seeing this higher high, which we have been unable to do since the high put in February, is there anything else that we could see that would convince us that maybe, just maybe, this bottom is real? Now, in front of us is a chart by Sentiment Trader, and I have it overlaid with the XLK because we're going to jump right into it. Percent of S&P technology sector stocks with a rising 200-day average. And what we're measuring here is from a 5% to a 75%. In other words, when we are under 5% of the stocks in the XLK with a rising 200-day moving average versus 75%, how fast that happens. Well, if you look at these data points, it does not happen very often. As a matter of fact, if you look at the red line, you could actually count them. And what's good is somebody actually did. Now, from 5 to 75, and you can see it right here, okay? This is the data that they have collected. And what's nice about this data is you can see that you have 7 signals. Now, there's a couple things that are interesting. We're going to talk about this negative after 1 week, and I can see why that could happen. There's another indicator, short-term indicator going off that shows that we could pull back, and I'm going to go through that right after this, and then we're going to get into the names that are going to benefit the most from this. So if we drill into this, we take these 7 times and we go into it and then say, okay, well, 1 week later, how did we do? Well, not so good, right? We didn't do too well. And that's why we get the worst performance 1 week later, which makes a lot of sense. You have a huge rally in the market after being down for a period in time, and people get suspect. It doesn't matter if it's 1963 or 2023, people are people and they're going to act the same way. It's the one constant. But if we take a look at this and go, okay, we've only been here 7 times, so there's got to be something to this. And then you drill out 2 weeks later and go, well, that data got a little bit better. The average a month later, and then you can see that 2 months later, 6.8. I just want to point something out before we get even further into this. If you look at the median price 1 month later, this is the percentage chance that you're going to be positive. You have a 71% chance that the XLK, this is not the S&P, this is the XLK, the technology sector, is going to be up 2.8% on average. If you go out to the median 2 months later, it's 6.8, 3.6%, 71% chance. 12 months later, if you follow this signal, 12 months later, there is 100% chance that you're going to be up and the XLK will be up 17.3%. It triggered today. Do with that what you will. In front of us is the data from the same study. So in other words, this study right here, percentage of S&P technology sector stocks with a rising 200-day average from 5 to 7%. And this is overlaying when that happens with the S&P, no longer with the XLK. But what does the S&P do during that same period of time? Well, if we go through this and take a look, you'll see the 1 week later what happens. Next week, you're usually down, right? It would not be surprising to see us come down or flat after window dressing and what happened this weekend, but nonetheless, let's see. And then we go through it and we start seeing that the percentages all of a sudden get better. Now, this is where it gets really interesting. You actually have a better chance 2 months later of the S&P being up than technology being up. Remember, before that number was 71% and now it's 100% 2 months later. So based upon this statistic right here, you have a 100% chance. Now, there's always a chance that it does not happen, right? But you have to look at this. And if you look at statistics and anything about statistics, that kind of rate of change, you need to pay attention to it. You do with it what you will, but you're looking 12 months later and they're saying 15.9% and there's a 100% chance that that's going to happen. It kind of fits in line with what we were talking about earlier, doesn't it? With the 1980 and this period in time and CPI. So all this is kind of tying together. Now, before we get into the SOXX and the rotations that we're starting to see, the charts that I just went over previously have been in the newsletter, and I would suggest that you get the newsletter link in description. Also, in that newsletter this week, I will be listing the top 10 stocks that I will be looking at and the top 10 index and sectors. The link is in the description. It should also be pinned to the video in the comments for easy access. So if you're looking right here and you see how you're flipping, right? And then everyone's saying, well, why didn't semis push today? Well, rotation. And that rotation came in the form of semiconductors going into software. In other words, we just kind of slowed down a little bit there, didn't we? And we saw cloud computing push up. Take a look at snow and what happened here today. It is a monster move that you have not seen in some time. Look at the volume. So now we have a volume spike. When was the last time we had like real volume spikes with this kind of move? It's been a while. Now, people are going to say, oh, it hasn't broken the 200 yet. And I agree. And it just gap filled. And there's a lot of work to do there. But you cannot rule out 10 points in a day, and you cannot keep equating it to the fact that, oh, it's just a short covering rally. This was not a short covering rally. This was institutional money being put to work because they are fear of missing out, and they're starting to understand what's happening. And right now, you still are in a position where the majority of bearishness out there is at historic lows still. If you go take a look at the AAII bearish, bullish sentiment indicator. So if you look at where you're at right here and you're looking at these pushes, and you saw this all across the board today, you saw it in every kind of name. You have biotech pushing today, making a higher high, and probably you're almost about a month high. You're about 3-week high. This is the kind of thing you want to watch. You're watching diversification. You want that rotation into different sectors. That rotation is healthy, and it's what keeps the market alive, because one sector does not get overpriced. Now, Meta is another example of consolidate. Everybody's waiting for the gap fill. And in the meantime, the stock just keeps going up. Here you have a gap up, and then you have another gap up. I mean, this is massive buying that's stepping in front of this name. This is exactly what you want to see. It's very hard to miss what's going on there. And this is what you want to focus on. So if you're looking at something like this, and I would suggest that you look at this, I currently have a position, these kinds of names can push because institutions like the idea that they're going to be able to be in something that is completely liquid. Now, Tesla was one that we bought today in the Alpha Chasers community, and you can see the little flag right here, the breakout, the retest, the breakdown, and then we just kept taking off. We did stock and options, and it did fairly well, obviously. I mean, it actually turned into a monster and got much stronger than I was anticipating. I wasn't anticipating this kind of run, but I obviously was very happy that it happened. But now, if we take a second and zoom in on the volume, well, when was the last time that you had an above average on my volume scale, that I'm above my moving average? Well, the last time that happened was back here, January. So this has been a very long time since I've had a reading like this. And that is something that I certainly pay attention to. I pay attention to volume, but when you start getting above my relative volume scans, I definitely pay attention to that. So I don't see how over the course of a week or two that we don't at least get some kind of test up here. And I think that's exactly what you're going to see. Now, this is a name we actually went over in the pre-market yesterday, talking about the breakout and how it was setting up. But let me just let me clear up these notes. If you don't follow us for the pre-market live streams, it's every morning at 8:15. They are on replay. So just make sure that you subscribe, click all notifications so you're notified of them. So you can just go watch the replays later. And what we were talking about was this flag. And then we were talking about how it has this little kind of wonky little flag here where you undercut and then flip. And then you had the nice little gap up there, right? I mean, it was perfect. Nobody was expecting this, no matter what they say. I mean, no one's complaining either. Nobody was complaining that it happened. But when you're starting to see this, people are like, oh, it's froth. It's not froth. It's mispricing of assets over a period of time. And you're going into an environment like we just talked about, where if CPI starts coming down and rates of the 10-year start getting above CPI, well, then you can start making money off buying the 10-year again. And that's going to drive up equity prices. It's just the way that the world works, you know. So if you take a look at our level right here, you probably get up to that 34 3/4 pretty quickly. Caveat, I do have, or I should say disclaimer, I do have a position in this right now. But these kinds of names are exactly what you want to see. And the market is telling you what it's thinking. And let me give you another example of this before we get into what retail's doing right and what I see them doing wrong in institutional sides. And I'll show you that in a minute. This is, again, from the newsletter. If you don't get the newsletter, link in description, and I'll tag it in the comments for just easy access. But if you take a look right here at how you're holding, they came out and said, BABA came out and said that they are in a position where they're looking at spinning off and splintering 6 different companies. The amount of money that could be made from this over the course of the next year or two, to me, is staggering. So again, everyone has to look at their own risk and make their own decisions. This is my opinion. I'm obviously not a financial advisor. I'm just a trader. But I look at this, and I've been through this a couple times. It's definitely something that's of interest to me, and it's something that I've seen play out. And I watched eBay do it with PayPal, and it created huge, huge value. And these kinds of IPOs, they do, but you have to think about something. Do an IPO, whether you're doing it in China or they do it on the Hang Seng, wherever they do it, that takes time. Why are they setting up now to go to the public markets? Because they know a year and a half from now that the public markets are going to be better, or they think they're going to be better a year and a half, because it takes a long time to put that together. This was a pretty clear signal that they felt that the market is starting to get a little bit stronger, that it could sustain new issues. Now, I did get a lot of comments to follow up on smart money, dumb money. I also got a lot of comments to follow up on trades that I do and do more of those live trades where I show you the actual move live. So I should have another video ready by this Sunday. We'll see how that goes, but just look out for it. It should be there. But if you take a look at smart money, dumb money, and we know what we call this. We call this institutions and we call this retail. If you're new here, you haven't heard that before, that's how we refer to it. What are we looking at here? Well, we're looking at the fact that retail is in red and they are buying, and institutions are starting to get a little bit weaker. So institutions now are selling, and at the same time, what are we saying? Retail buying. Well, most people are going to look at this and go, well, that's dumb money. Well, no, that's what they want you to think, right? So it's not dumb money. If you take a look at it, you can see right here that we sold, retail sold at the high, okay? And then as the market was dropping, institutions are buying, but what's retail doing? Selling to them and taking a profit. Now what are they doing? They're buying. Here, look at this over a year to date. That right there. You see the cross right here and how institutions picked up the slack? Same exact thing is happening right here. It's getting closer to happen again. Go back a year and take a look at what happened in October and how retail bought and did exceptionally well as institutions got out for the largest move that we had in about a year. So I would not view this as a negative that just, oh, they're selling. It doesn't really work that way, right? I mean, yep, they sold here and then that would have been the high. Okay, well, they sold here and they sold at the low. So if you start thinking about it from that perspective, don't just assume because this says smart money that what they're doing is right and what retail's doing is wrong. Just look at what the S&P is doing based upon the movement of their actions, and that'll tell you everything. Now, I did say that there was a sign that we should go over where we're seeing the possibility of things getting a little overheated in the short term. And in front of us, there's S&P stocks above the 5-day moving average. And you'll remember when we just looked at that one chart, how I was saying, hey, by the way, yeah, I can see why you might be down for like a week. Well, whenever you get up to this level, this 95, 96 level, and you have that amount of stocks over their 5-day moving average, you're at a high. And usually that high, you'll back off. You might regress back to your 200-day moving average. But this is a sign that you might be a little overheated right now after today, and that you might see a pullback on Monday or Tuesday. For me, looking forward, going out weeks, that would be an opportunity for me, barring any news that leads me to believe that we're in a Lehman kind of event. And I don't see that right now. But if you take a look at this and you just look at these dates, for example, you'll go back and just go and look at the market and see, oh yeah, there's a little blip there. And yep, we did come down. And it works the same way down here. When you get to about a 2, you start to see that kind of reversal. So I hope this was helpful. Please comment below. Your comments are greatly appreciated. I like doing this broader content and getting more specific. I think it helps people understand the macro picture. If you are struggling with day trading at all, I have gotten a lot of really good comments on this video. And I think this video can help greatly with a very simple system that you can learn in about 10 minutes to implement and try to make your own. Everybody have a great day. Trade to win.